Welcome back to BEM Academy. I'm Ege. In the first episode, we learned what a financial market really is. Today, we go on one level deeper. We are zooming in the three markets you'll actually trade with BEM funding: Forex, indices, and commodities. By the end of this video, you'll know what each of them are, how they move, and where to start. Let's dive in. In the next couple minutes, we'll learn four things. 1. What Forex actually is and why it's the biggest market on earth. 2. How indices let you trade entire economies in one click. 3. What makes commodities tick. And finally, 4. The key forces that move all three. Let's start with the biggest of them all. Forex, short for foreign exchange. It's the market where you trade one currency against another. Now here's a number that should shock you. Over $7 trillion moves through the Forex market every single day. That's bigger than the global stock market and the entire crypto market combined many times over. It runs 5 days a week across 4 major sessions, which are Sydney, Tokyo, London, and New York. When you trade Forex, you're not buying something physical. You're betting that one currency will strengthen against another. That's it. All Forex pairs fall into the 3 buckets. First, majors, the most traded pairs in the world, and they all include the US dollar, such as Euro/USD, GBP/USD, USD/JPY, and USD/CHF. They have the tightest spreads, the deepest liquidity, and they react to every major piece of news. Then we have minors, sometimes called crosses. These are major currencies but without the dollar. Euro/GBP, Euro/JPY, and AUD/NZD. And finally, exotics, a major currency paired with an emerging market currency. Bigger spreads, wilder moves, much harder to trade consistently. As a beginner, it's always safer to stay with the majors. So what actually makes Forex move? There are 3 big forces. First, interest rates. When a central bank raises rates, that currency usually strengthens. Money flows to where it earns more. Second, central bank announcements. When they speak, the market listens, and pairs can move hundreds of pips in seconds. And finally, economic data. Inflation prints, jobs reports, GDP releases. These shape the expectations that drive every move. If you understand these 3 forces, you understand about 70% of why Forex moves. And now, indices. An index is a basket. Instead of buying one company's stock, you're trading hundreds of them at once, packaged into a single number. The S&P 500 is the 500 biggest companies in America. The Nasdaq 100 is the 100 biggest tech and growth names. The Germany 40, Germany's top 40 companies. When you trade an index, you're not betting on one company succeeding or failing. You're betting on the direction of an entire economy. Here are the 4 you absolutely need to know. The S&P 500, also called the US 500 or SPX. It's the benchmark for global risk appetite. The Nasdaq 100, also called Nasdaq, tech-heavy, more volatile, the favorite of swing traders. The US 30, also called the Dow Jones, 30 massive industrial names. And finally, the German 40, formerly DAX, Europe's economic pulse. These 4 cover the vast majority of index volume you'll ever trade. Indices move on 3 things. First, economic data. Inflation, jobs, GDP, the same data that moves Forex. Second, earnings season. When companies report quarterly results, indices can swing hard. And finally, market sentiment. Fear, greed, headlines, geopolitics. When traders are scared, indices fall. When they are greedy, they rip higher. Volatility on indices is usually lower than crypto or exotic pairs. That's both a blessing and a curse. Calmer moves, but also fewer fireworks. Now we'll leave the digital world and step into the real one. Commodities. A commodity is a physical, raw material, something you could literally hold in your hand. They split into two big categories. Hard commodities, they are extracted from the earth: gold, silver, oil, copper. And soft commodities: grown: wheat, corn, coffee, cotton, or sugar. As a retail trader, you won't be taking delivery of barrels of oil. You'll trade contracts, CFDs, or futures that track the price. Three commodities matter most to the retail traders. First, the most important one: gold, the classic safe haven. When fear rises, gold usually rises with it. The most traded commodity by prop firm traders worldwide. Second, oil, split into WTI for the US benchmark and Brent for Europe, hugely sensitive to geopolitics and OPEC decisions. And finally, silver, cheaper than gold, more volatile, often follows gold but with bigger swings. Commodities are driven by four forces: supply, how much is being produced and stockpiled; then demand, how much industry and consumers actually need; the US dollar, most commodities are priced in dollars, so when the dollar strengthens, commodities usually weaken; finally, geopolitics, wars, sanctions, OPEC announcements, weather events. Commodities are the most directly tied to the real world of all the markets we've covered. To sum up, let's move to the key takeaways. 1. Forex is the biggest market on earth, driven by interest rates, central banks, and news. 2. There are three Forex tiers: majors, minors, and exotics. Start with the majors. 3. Indices let you trade entire economies in one click. 4. Commodities are physical assets driven by real world supply, demand, and geopolitics. And finally, 5. All three markets still follow the same first principle from episode 1. Prices move when supply and demand break their balance. You now know what Forex, indices, and commodities actually are. In the next episode, we'll go into more technical stuff: pips, lots, and leverage. If you're ready to put what you've learned into practice, BEM funding helps you do that. You take the trades, BEM takes the risks. Link is below. I'll see you in episode 3. Take care.